Here's something that should bother you. Your grandparents bought a home just to live in, and you buy a home, or at least you try to, not just to live in, but also as an investment, something to build your wealth. And that shift, that's not just a cultural change, that's not just the market, it's the result of specific policy decisions that fundamentally transformed what housing is in America. Shelter has now become a financial asset, and once you see how it happened, the exact laws, the exact incentives, the exact moment everything changed, you can't unsee it. So in this video, I'm going to show you how homes stopped being a place to live and became investment vehicles. And fair warning, once you understand this, you're going to be angry because this wasn't an accident, it was engineered. Okay, so let's start with what you think is happening. Housing is expensive because of supply and demand, right? There's not enough homes and there's too many people. It's basic economics, and sure, that's definitely part of it. But here's the thing, housing didn't naturally become expensive. It was engineered to become an investment vehicle through specific laws, tax policies, and financial innovations that turned shelter, something you need to survive, into a financial asset. Before the 1970s, housing was primarily treated as shelter first and kind of like an investment second. People expected modest appreciation, but homes weren't viewed as like these wealth-building engines the way they are today. Post-1980s, housing became an investment asset. It's like a stock. It appreciates, you leverage it, you profit from it, and you buy it to build wealth. But that shift wasn't natural, it was created. And to show you how, we have to go back a bit. In the 1940s through the 1960s, this was the golden age of housing affordability in America, and the numbers are kind of crazy when you see them. The median home price was only 2 to 3 times the median household income. So if you made $5,000 a year, homes cost on average between $10,000 to $15,000, and your average down payment was about 10 to 20%. And your time to save for that down payment would be about 2 to 3 years. And home ownership rates went from 44% in 1940 to 64% by 1960. So why was it so affordable? Well, financing was limited, mortgages were 20-year fixed, and you needed a big down payment. Banks were very local and conservative, and it was actually hard to speculate on houses. The transaction costs were high, it wasn't very liquid, and housing, it wasn't really an investment. It was kind of where you lived, and it appreciated a little bit. During that time, wages kept pace with housing costs. There were strong unions, good manufacturing jobs, and a single income could buy a house. And here's the key. Houses were for living in, not investing. You bought one house, you lived in it for 30 plus years, and you paid it off. That was it. The concept of flipping, it didn't exist. Wealth came from your income and your savings, not from your house going up in value. What your grandparents probably experienced was you get married at 23, you save for 2 to 3 years, maybe you buy a modest 1,200 square foot house for like $12,000, and around this time you're making around $5,000 a year, you pay it off in 20 years, and your house appreciates modestly, maybe 3 or 4% a year. And then you retire with a paid off house worth like $50,000. During these times, the house was primarily a place to live in that happened to hold value. It was not a primary investment with shelter being secondary. And that's a big difference between where we are today. Now, this transformation from shelter to investment, it didn't just happen. It was created by specific policy decisions. To be clear, zoning laws, population growth, immigration, and construction costs all definitely matter too, but those explain supply. What changed demand and behavior was policy. The first policy to change was something called the Tax Reform Act of 1986. And basically what it did was eliminate most tax deductions. Things like credit card interest, car loan interest, most consumer debt interest. But what it didn't eliminate was the mortgage interest deduction. And this made housing debt the only tax-advantaged consumer debt in America. Suddenly, taking on housing debt was financially rewarded, while every other kind of debt became more expensive. The incentive completely changed from buy a house you can comfortably pay off to buy the most expensive house possible and deduct the interest. This pushed home prices up significantly over time, and the benefit largely went to the sellers and the banks, not really the buyers. Second, and this is the big one, was something called the Taxpayer Relief Act of 1997. And this is where everything changed. Before this law, capital gains on home sales were taxed like any other investment. After this law, you could take up to $250,000 in gains, tax-free if you're single, or $500K if you're married. And there was no limit on how many times you could use this exemption. This made housing the most tax-advantaged investment in America. Compare it to stocks, where if you sell a stock for a $250,000 gain, you pay about $50K in capital gains tax. But sell a house for a $250,000 gain and you pay zero, nothing. No other investments let you do that. So millions of people started buying homes not to live in them, but as tax-free investment vehicles. And this poured massive amounts of capital into housing, driving prices way up. And the third thing that changed was financial deregulation and Fed policy. Through the 80s and 90s, banks were allowed to make riskier loans and package them as securities. This led to exotic loan products like interest-only mortgages, adjustable rates, loans to people who couldn't really afford them, and more money could now start flowing into housing. The 2000 to 2006 bubble saw prices rise 124% nationally. Then 2008 crashed everything. But here's what's crazy. Even after the crash, these policies stayed in place and they added more. From 2008 to 2015, rates were basically zero while mortgage rates hit 3 to 4%. But then the Fed bought $1.7 trillion in mortgage-backed securities, directly pushing down rates even lower. Then COVID hit and rates dropped even lower, from 2.5% to 3% mortgages. Now add stimulus checks and work from home demand, and cheap money flooded into housing again. And the result? From 2020 to 2022, home prices jumped 40+% nationally. See the pattern? Every crisis, the Fed makes borrowing cheaper. And this inflates asset prices, including housing. Now here's what made everything worse. Wall Street discovered single-family rentals. Pre-2008, landlords were mostly individuals or small-time operations with a few properties. Post-2008, that changed. Blackstone, Invitation Homes, American Homes for Rent. They bought tens of thousands of foreclosed homes, turned them into rentals, and created a whole new asset class. These companies, they own hundreds of thousands of single-family homes because rental income from them provides reliable cash flow they can raise with inflation. And here's the effect on you. When you're trying to buy a house, you're sometimes competing against Wall Street funds that can pay 10 to 20% over asking, all cash, and they can close in a week. You can't compete with that. In 2021 to 2022, investors bought something like 28% of homes sold. And in some markets like Phoenix or Atlanta, it was 30 to 40%. Meanwhile, first-time home buyers dropped to 26%, the lowest in decades. So you're not just competing with neighbors anymore, you're sometimes competing with trillion-dollar funds. And all of this creates a flywheel. Policies make housing a great investment, investors buy houses, prices go up, housing becomes an even better investment, and more investors buy. And you just repeat this forever with first-time home buyers getting completely screwed. The generational divide now is brutal. Boomers bought houses for 2 to 3 times their income, and those houses are now worth 8 to 10 times income. Whereas millennials and Gen Z face houses at 8 to 10 times their income from the start. To look at this in real life, if you want to save a 20% down payment on a $420,000 home, that's $84,000. When median income is $75,000, if you save $10K a year, it takes 8 to 9 years for that down payment. But home prices also rise about 5% annually. So you're chasing a bus that's accelerating away from you, and by the time you save enough, you need even more. And the result is average first-time buyer age is now 36 when it was only 31 in the 1980s. This creates a new class structure. homeowners who accumulate wealth, and renters who have their wealth taken from them. And you can't easily move between the two. So why don't we fix this? Because the government and homeowner organizations have a strong incentive to keep prices high. If you bought a $600,000 home and someone proposes a policy to drop prices to $300,000, you just lost $300,000. So homeowner organizations, they oppose new construction, they support restrictive zoning, and they vote for politicians who protect property values. They're not evil. Their retirement depends on housing staying expensive. And homeowners vote at much higher rates than renters. And politicians need their votes. So policy favors homeowners, which keep prices high. And this creates more renters who have less political power, and the cycle continues. And almost everyone involved is acting in their own best interest. Investors buy houses because it's a good investment. Homeowners protect property values because that's their wealth. And banks issue mortgages because they can profit. And politicians, they maintain policies because homeowners vote. No one's evil. Everyone's playing the game they're in, but the system is broken. And when the only way to build wealth is to own a home, but homes are too expensive to buy, you've created a trap. A whole generation of people locked out, not because they're lazy or they're bad with money, but because the incentive structure changed before they entered the game. So what do? I'm not saying buy a house or don't buy a house. What I'm saying is understand why housing works this way. It's not just supply and demand, it's policy, it's incentives, it's who benefits from high prices and who doesn't. And once you see that, you can make better decisions. Maybe you buy anyway, knowing it's a bit overpriced, but you need shelter, or maybe you rent and invest the difference. Maybe you move somewhere cheaper, maybe you get politically active, but at least you understand the game. Because right now, most people don't. They just feel like they're falling behind, and it's not their fault, it's the system that failed them.